Hi there, this is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the Portfolio Manager of Fundstrat's U.S. Large Cap Granny Shots ETF. This is our update for the week of April 18th. I want to cover some particulars before talking about the Granny Shots ETF. As of April 17th, the price was $17.46, net asset value $17.47, and total assets of $826 million. For the past week through April 17th, Granny Shots had fallen 1.13% compared to the S&P declining 1.49%, or relative outperformance of roughly 36 basis points. Now, as has been the case for the last few weeks, I wanted to start this by talking about the macro, and markets have been turbulent since April 2nd. We know why. It's Tariff Liberation Day. It has caused a lot of turmoil and anxiety and uncertainty, and it, of course, is the worst macro period for markets, and at least from in my 30 years that I've ever seen. It's worse than COVID. And in our videos that we've published over the last few weeks, we've decided to orient some of the conversations to macro because correlations between all the stocks has risen so much. But our message has been the same, that the macro has gotten messy, but the economy does not appear to be unraveling, and therefore we don't think you should get too bearish. For instance, 4 weeks ago, we said there's a lot of dry powder that's capable of fueling a V-shaped stock rally. 2 weeks ago, we talked about how Tariff Liberation Day is a macro negative, but there was a probability of new trade deals coming. And last week, we talked about how markets very likely made their structural low last week, which was last week, or 2 weeks ago, because it was last week, and that we saw risk reward in NVDA and Tesla, and of course, the fact that the VIX had fallen. So we're still through this period of turbulence, but because of developments this week, I believe that this is all resolved in a positive direction for stocks. So let me explain. There has been this conflict because the macro remains uncertain. If you're only focused on macro, you'd be nervous for these reasons I'm listing here. But if you looked at the equity markets, these things are actually would get you quite constructive. And so this was the battle that had been taking place for the last few weeks between the stock market internals and the macro outlook. If you're macro, you might say we're facing economic Armageddon. That's something that Bridgewater has talked about, a different world order. Some people talk about the end of American exceptionalism. Others say that the top is in for the US stock market, similar to Japan in 1989. And of course, there's many people telling you that you should only be in gold and muni bonds. And gold, of course, is doing great, up 26%. It's the best since 2010. And of course, many people think there's opportunities in muni bonds. But the story of the equity market has been different. There's been pervasive bearish sentiment. You know, the AAII percentage of bears has been over 50% for 9 weeks. And the internal low was registered. We talked about that when you look at the VIX. That a VIX going over 50 and falling below 31 has always marked an internal low. And then later in this video, I'm going to talk about the 4 signs that a bottom is in. But at the end of the day, I think the equity market got this right, and it's resolving. Things are now resolving positively for stocks. So what are these signs of a bottom? Well, there's 4 of them, but I'm not going to take it in chronological order. I'm going to start with what was triggered this week on April 24th, which is a Zweig breadth thrust. Now you're wondering, what is a breadth thrust? It's developed by Marty Zweig. It looks at a 10-day moving average of advancing versus declining issues. And the idea is when it goes from oversold, a reading below 0.4, and then back to 0.615 over 10 days, that's a bullish reversal. That has happened 11 times since 1978. And notably, 1 month, 6 months, and 12 months later, stock markets are always up. And this was triggered on April 24th, which was Thursday. On Wednesday, April 23rd, the high yield market options adjusted spread recovered 50% of the widening. What I mean by that is on January 24th, high yield spreads were 292. They exploded to 530 basis points wide on April 7th, but they touched 409, which is below the 50% retracement. That's a positive development because we are now walking back from a recession risk. If high yield spreads had gone from 500 to 1,000, a recession was guaranteed. But instead, it's reversed almost all the widening back to even levels before April 2nd. On April 22nd, again, happened this week, we had 2 consecutive 90% advancing days. That means that stocks within a couple of days apart had posted 2 days where the advancing gains were 90% or more. And as you can see here, this 3 times since 1979, stocks are higher 3, 6, and 12 months later. And that happened on April 22nd. Now, I covered this last week, but the VIX closed below 31 after going above 50. So the last thing, of course, that would probably convince everybody that the bottom is in is if the stock market recovered 50% of its decline, which is 54.91 on the S&P. So that's the level to watch. The S&P peaked at 61.47 on February 18th. It fell to 48.35 on April 7th. The halfway recovery point is 54.91. And we closed on Thursday at 54.85. So we're 6 points away, 0.1%. So almost there. And of course, that really amplifies and confirms what we've been saying for the past few weeks, that we're still in a bull market. I know it's been horrific and feels terrible. And it was not clear to us if this would be a V-shaped bottom or a range trading bottom like 2011. Now, there are things that can go wrong. I covered this last week. The tariff war with China could turn into a Cold War. Are the shocks going to lead to a global recession? Not yet, but of course they could. Could the financial crisis lead to rapid deleveraging? Could inflation expectations explode? Could S&P estimates fall a lot more than 20%? Maybe. These are the things that people are going to worry about. But we also think stocks got really washed out. And as you know, I've been talking about this with Tesla, that Tesla, we think, got so washed out that they reported terrible earnings on Tuesday after the close this week, and the stock rose and has actually had 2 consecutive gains now, and now solidly trading above its 20-day moving average. That's constructive in my view, and it's a positive surprise. Similarly, Bitcoin's finally catching a bid. Bitcoin fell while gold rose during the February to April period when asset markets were deleveraging. And that's because institutional investors were cutting leverage, and when they're cutting leverage, they're cutting their Bitcoin longs. But in the last couple of days, the opposite's happened. Gold actually has been cooling and Bitcoin's been rising. And I think there's a convergence trade there, and that's a lot of upside for Bitcoin. And that's good news for MicroStrategy, which, as you can see here, did not make a new low on April 8th. It bottomed on March 11th at 231. So again, a lot of important, thematically important stocks have looked like they washed out. In terms of GRNY performance, individual stocks by week, the top 5 performers in the past week were Netflix, Palantir, MicroStrategy, Abbott Labs, and Costco. And the bottom 5 contributors were Microsoft, AMD, Amazon, Meta, and NVDA. In terms of themes, the #1 performer was cybersecurity, really led by Palantir. The second is the style tilt. Again, and that's the benefit of us using style tilt because that changes every quarter, but you can see Netflix, Palantir, MicroStrategy are really driving those upside gains. And seasonality was a drag, and you can see that's really driven by Meta. And easing financial conditions really benefited, again, from Netflix's inclusion, as well as Garmin and some others. So just to reiterate, if you're wondering why do we call this granny shots, it's referring to an unconventional way of shooting a basketball free throw, popularized by Rick Barry, who made 90% of his shots. It's underhanded versus most people who shoot overhanded. We achieve a granny shot by creating, focusing on themes that we think are structurally important over the next 10 years, like millennials, global labor suppliers, the rise of automation, cybersecurity, financial conditions easing. We also look at style tilt, seasonality, and things like PMI recovery. And not only do we focus on those themes, we find the strongest stocks associated with each theme. But then to be a granny shot, you have to appear in more than one theme. So therefore, stocks that appear most often are the strongest granny shots, as shown here: Google, Meta, Palantir, Apple, Caterpillar, Garmin, and NVIDIA. There's a lot more information on our fact sheet, which can be found at grannyshots.com. And this is our investment team. That's it for now. Thank you, and I'll speak to you soon.